You are listening to Mining Stock Education.
You wind up with an NPV of $639 million and an IRR of 84%, which is very attractive. And the full toll milling pays you back in 1.15 years. So I think this goes to show us, answers our thesis of, should this be built? And I think it's very clear that it should be.
I come from a financial background. I'm looking at the IRR. I'm looking at the return. Going in the future, it's harder and harder to find these big mines. These are the mines that are going to be popular. These are the mines where you can make a lot of money.
Thank you for tuning in to Mining Stock Education. I'm your host, Bill Powers, and in today's show, you'll be getting an update from one of our sponsors, Fury Gold Mines. I'm speaking today with Director and CEO Tim Clark, as well as the SVP of Exploration, Brian Atkinson. Gentlemen, welcome back onto the show. And you just put out a preliminary economic assessment, a PEA, on your Eau Claire project in the James Bay region of Quebec. You laid out 3 different scenarios that we should talk through. And Brian, can we begin by talking through the base case? The base case you put here, after-tax NPV 5 of $554 million with an after-tax IRR of 41%. Talk us through this, and what inputs did you put into this base case in which you came to this conclusion?
Yeah, thanks, Bill. No, I think the base case is one where it's a full standalone operation. So our own mill, everything on site at Eau Claire. And it just gave us some really good optionality. We used $2,400 gold price, a 73.73 US dollar Canadian conversion. We were pretty conservative on it. The resource that we done last year was done at $1,900 gold, which was the basis for this. And then our mine plan was at $2,200 gold. And then in the end, we decided on $2,400 on the financials side of things. So there's a lot of built-in inputs in there. And, we started with the base case, and then we did a hybrid case with 2 years of toll milling. We're in a region with great infrastructure, good roads, good power around. So that gave us a little bit of optionality. And we saw a good increase on the NPV from that $554 million to $610 million on that with a 53% IRR. And then, we asked ourselves, if we could get a full toll milling agreement going, what would that look like? And obviously those numbers look the best. You don't have, your CapEx is way down. You wind up with an NPV of $639 million and an IRR of 84%, which is very attractive. And all of these, the standalone has a 2.5-year payback, the hybrid has a 1.5-year payback, and the full toll milling pays you back in 1.15 years. So it's, Eau Claire it's a high-grade resource. It's road accessible in a great, jurisdiction in the James Bay region of northern Quebec. And, I think this goes to show us, answers our thesis of, should this be built? And I think it's very clear that it should be.
Tim, you deal with pressure from investors, also potential buyers. So when you're putting of this project, so when you're putting the economics on this, you highlighted a total recovered gold production of 834,000 gold ounces, and you had an 11-year mine life with 76,000 gold ounces per year. Now, this didn't meet the commonly discussed metric of at least 100,000 gold ounces over 10 years. Did you feel any pressure to kind of fit this study into that?
It's funny, like everybody, they want you to get to the 2 million ounces. They want you to get for overall resource. They want you to get to 100,000 ounces. And I come from a financial background. I'm looking at the IRR. I'm looking at the return. And so I think, look, going in the future, it's harder and harder to find these big mines. These are the mines that are going to be popular. These are the mines where you can make a lot of money still. And I think this is really exciting because, look, we have leaned more conservative through the last 4 years that I've been here in terms of not being that company that over promotes, because I think this asset was over promoted before. But these numbers are awesome. And I think that it's pretty clear that this should be built. And what's better is that there's a lot of ounces to come into the resource. So you remember it's 1.88 million with Percival, And this is only half of that, not even half of that that's coming into this mine. If gold price is put in there at a higher number, like $3,000 gold, then that's still at a discount. It lowers the grade, and all of a sudden a lot more ounces come into this. So there's potential to raise this up to closer to that 100, if not over 100,000 ounces a year. But this is the model that we wanted to give everybody so they can make those tweaks themselves. And again, $2,400 gold is pretty conservative. And I think that my view is that gold is still going to go higher. It's at close to 34 right now. So we gave $1,000 a gram cushion on this. And to me, this is like, tremendous upside, which is basically what we've been trying to tell investors for the last 4 years. This resource is better than what I think everybody expects it to be.
Brian, when the Eau Claire asset was held by East Main before the acquisition by Fury, they did a PEA about 7 or 8 years ago. How does your PEA compare to theirs?
Well, the ounce production's about the same. They stretched things to try to get to that magic number of 100,000 ounces over 10 years. They didn't quite get it then. What we've done, though, is we've improved a lot of the geometry on the veins, as particularly on the eastern side of the deposit where it's the deepest part and the highest grade. And so that improvement has let us do basically the same ounce profile production out of it with 15 kilometers less of underground infrastructure. So we're not stretching out to these marginal or, minorly economic stopes. We kept it tight and focused on, there's a nice tight underground scenario with a small open pit that clearly makes some money. So that's what we want to focus on. And as Tim said, just at the Eau Claire resource itself, there's another 800,000 ounces there. A lot of that's in our new hinge target, and part of the reason it didn't make it our cutoff into the stoping model was just some continuity, and that's what we're hearing from some of the bigger companies that we've taken through this is work on that continuity. We like the project. The grades are fantastic. We have our diluted overall grade, open pit and underground combined, is 5.22 grams per ton, which is pretty sweet. And then, it's just that there's so much opportunity there. We're only drilled down to 650 meters below surface. The resource goes down a little bit deeper just because you can stretch it some. But if you look in orogenic gold systems, particularly in the Abitibi, which is just to the south of us, those deposits go down to 1.2, 1.5, 2 kilometers below surface, right? So not only are we just scratching the surface, we've kept it nice and tight, and we get a lot of ounces right off the hop, and it looks really good.
Tim, the IRR for the toll milling scenario that you laid out, you had at 84%, and that's at the lower gold price, not the current gold price, as you mentioned. So that's going to lead the investor to ask, okay, faster to production, faster payback time, greater return on capital, but who would the toll milling partner be?
Oh, well, I think I don't want to speak out of turn because we haven't spoken to anybody else about this in terms of other producers. But I think everybody can kind of look at a map and say the biggest mine operation up there is the Éléonore mine. So we haven't shared it with them. We will, and I'm curious to hear their opinion, what it might look like for them and their interest list. But the base case is really why we put the base case out, is because as a standalone, this thing works. It can move forward, but if the Éléonore group wants to get involved and we figure out some way to do toll milling with them, I think that would be where the huge profit margin would come from. I think, I look back and my conversations with some of these CEOs of bigger companies, big producers, and I've asked them, what do you do when there's inflation in the market? And they said it's easy. You own big swaths of property, big land. So, and I've said this before with you guys, is you don't want to own 1 mill, or 5 mills, you want to own 1 mill with all these resources coming in. And so I think the area is very attractive to consolidation, but by no certain means do we need it to happen to make money here. And I think that's the big message.
Brian, talking into the future, after a financial investment decision would be made, what would be the difference in the build out if you did the base case here where you processed and milled everything on site versus toll milled? Like, what would be the time frame that would cut out toll milling?
Well, you'd lose a year of construction, right? Because you wouldn't have to build that plant before. So, and what it really does is it pushes your NPV up. So you're borrowing less money over, the length of time. So, it would save a full construction year on it.
And environmental studies, I would guess too, right? You wouldn't have to do as many environmental studies.
That's right, because your tailings would be stored offsite as well at the toll milling facility. So they would, basically take all the plant infrastructure. We built in a sample tower and some crushing and that to be able to get it shipped. So we do have a bit of construction to do at site, but yes, the environmental studies, the engineering studies, and then the construction time period are reduced.
Brian, obviously the discount rate and the gold price are key sensitivities in any study. Are there any other sensitivities you'd like to point investors to?
Yeah, when we originally looked at it, we were playing with an 8% NPV and our discounted NPV. And I think that's more realistic. The market uses 5% NPV. So that's what we went for, so that investors can compare apples to apples rather than us trying to be, everybody, I think, is getting the sense that we're pretty conservative on these things. So rather than us being, putting out an 8% discounted NPV, we stuck with the 5%, which is just because that's what everybody else does. But I think more realistic is 8%, and we went as high as 10% in our sensitivity tables, which will come out in the 43-101, and it all still works, right? There's not a scenario, other than gold going back down to $1,000 an ounce. There's not a scenario where this doesn't work.
Your 76% of the ounces you put here are in the measured and indicated, we should point out. So only 24 are in the inferred. So what does that do for your timeline to a PFS if the Fury board authorizes that?
Again, it just speeds things up because so a PEA, you can use inferred ounces in that. But as you move to the PFS and FS, you can only use measured and indicated ounces. So, a lot of these companies, you see, they talk about $50 million to get from the PEA stage to the PFS, and a lot of that's resource conversion drilling. Whereas we stuck with, where we had the tightest control on those ounces in our measured and indicated. And so it just shortens that time of converting those few ounces. And as you convert ounces, you're probably going to add some ounces in, and we'll tweak the models and that as well. And if gold price keeps going up, as Tim said, we our underground infrastructure is built on $2,200 gold. So even if you use $2,400 gold, you're going to get some more ounces coming in. Never mind improving that continuity on the hinge side. And converting some of these ounces. The thing about Eau Claire is, as you go from inferred to indicated, you're gaining about 10-15% in grade. And then from indicated up into measured, you're gaining another 10 or 15%. So it's not one of these deposits that totally falls apart when you get tighter drilling on it. It actually improves as you get tighter drilling.
Tim, so in terms of the Eau Claire project, is Fury an explorer still, or are you a developer now?
Well, I think that as you move from explorer to developer to producer, your multiple goes up. And I know right now that a lot of the market is focusing on paying those guys. And I think that that's the ultimate goal here is, and look, we got in this company not to just pop out a few drill holes. We want to make sure that this adds to a real resource, and we could either build it ourselves or sell it. Again, it's not our expertise to be a mining company itself, but that's the way some of the biggest ones have gotten started. So right now, what our goal here is to bring production as close to the line as we can, and show a pathway to that, and that's where you get value for that asset. But this asset is a lot better, I think, than people suspect. And we've been trying to tell that to everybody for a long time, and now we got something to really significant to point at. And I think investors should take a look. We've got the Beaver Creek conference coming up in about a week. My guess is we're going to get a lot more requests for meetings from some of these producers, particularly in the mid-cap size.
And investors, in addition to Beaver Creek, should look forward to some drill results too you have outstanding, right?
We do. And so this is kind of an opportune time for us because we've got the Sakami and Committee Bay projects basically finished. We've only put one hole out on Sakami so far, but our plan is to start putting out results from both of those in the next coming weeks and month. And we're excited because they've been some really good swings, and we think some low-hanging fruit at Sakami, and we think some big opportunity up at Committee Bay.
The company, again, is Fury Gold Mines. They're a longtime show sponsor, ticker symbol FURY in New York and Toronto. Gentlemen, thank you for coming on the show and providing this update.
Thanks, Bill.
Thanks, Bill. Yeah.